going to go into our non-refundable credits. So far as we're going through our topics, we've touched on already like the basic information, who must file, the filing statuses, dependents on there, our income. We've subtracted any adjustments to get to our AGI, our adjusted gross income. Also, we've subtracted either the standard deduction or the itemized deduction to reduce that AGI even further. And we've also, for those self-employed individuals, we've also subtracted the qualified business income deduction. So once we've subtracted all of those, we've gotten our taxable income on the tax return. And then we've determined, we go to the tax table to find out, based on that taxable income, their filing status, what is their tax liability? So TaxSlayer is going to compute all of that. So now the tax liability means at this point of the tax return, what is the amount that is owed, or what should they have paid into the IRS? So we get the tax liability. So now we're looking at these, right now, these non-refundable credits. These non-refundable credits, the goal is to reduce that tax liability and get it close to zero as possible. After these non-refundable, we're going to be looking at other taxes. So what is increasing the tax liability? And then we go back and look at payments and refundable credits to, again, what's going to reduce the tax liability and what can reduce it past zero where it produces a refund, if there is one. So non-refundable credits, tab G. A non-refundable credit is a dollar-for-dollar reduction of the tax liability. A non-refundable credit can only reduce the tax liability to zero. So the example, a taxpayer has a tax liability of $1,000 and the non-refundable credit is $1,200. The tax liability then becomes zero and the remaining $200 is lost on there. So this is what the non-refundable credits do. So this is also on our Schedule 3, Part 1, non-refundable credits. We're going to take all of those non-refundable credits and it goes again to the Form 1040 from this schedule. So the first one is our foreign tax. So U.S. citizens and residents compute their U.S. taxes based upon their worldwide income. Taxpayers who pay taxes to a foreign country or U.S. possession may be entitled to a credit on their U.S. taxes. Taxpayers who receive Form 1099 interest, dividend, or Schedule K-1 may have amounts indicating that foreign taxes have been paid on behalf by the issuer of the document. So this is, again, you'll see on those 1099 interest or dividend, or that K-1 where it talks about foreign tax, and you've already taken care of this. And so again, TaxSlayer handles the computation for us, and it's going to move that foreign tax on that form. It's going to move it over here on this credit side. And so this gets taken care of for us. The foreign tax credit is taken care of when we enter the forms. It will appear on Schedule 3, Part 1, Line 1. Then we have our retirement savings contribution credit. So we've talked about this credit a little bit when we entered in the W-2 and we saw that box 13, retirement, was checked. We also saw if maybe they also had in box 12 a code D or code G. There could be some other codes. We could have also saw this taken care of when we entered in a person's traditional IRA contribution. So the retirement savings contribution credit is a non-refundable credit eligible taxpayers may claim if they made a qualifying contribution to a retirement plan. If the contribution is tax deductible, such as a traditional IRA, the taxpayer receives the benefit of the tax deduction and a tax credit. This is considered a double benefit and is rarely allowed. So again, that's for the traditional only. They're able to write the deduction off on their tax return, and because they've contributed, if their income is within the applicable range, they can also receive this non-refundable credit. Contributions to a non-tax deductible account, such as a Roth IRA, can qualify for the credit as well. So this is the chart that we use for the retirement savings contribution credit. It's going to look at their AGI, so their adjusted gross income, so their income minus adjustments, and you'll see that it is maxed out at $68,000, but that's for a married, filing joint. For a single individual, it gets maxed out at $34,000. And you'll see these are the percentage ranges of their contribution amount. So if a person is, say for example, a single individual, their income, their AGI is under a little less than $34,000, and they contributed $1,000 to their retirement account for the year, they're only going to get 10% of that. So they'll get a retirement savings contribution credit of $100. So you'll see their range, whatever their filing status is, and that percentage of what they contributed to that retirement account on there. So this is in your 4012 page G-16. And again, we've already entered this information in when we did the W-2 and their traditional contribution. TaxSlayer is going to calculate this retirement savings contribution credit for us. So what you're kind of getting right now is pretty much when you see it listed on the tax return, then you'll know like what makes up that credit, how it's calculated. This credit, the elderly or disabled, we rarely see this one, so we're just going to kind of go through this one briefly. Individuals who qualify for the elderly or disabled credit are age 65 or older, are under age 65, retired on permanent and total disability, receiving taxable disability income, and under the mandatory retirement age their company has set. This is the chart on here for them to qualify for this credit. On here, we hardly ever have anybody, I haven't seen anybody at my site qualify for this credit because they're either receiving just Social Security benefits, which means they're not required to file a tax return, or their income puts them over the threshold, the AGI amount to qualify for this credit. So this is another non-refundable credit. Then we have the Child Independent Care Credit. So also, you're probably going to see some people probably coming in and asking questions just because there's been a couple of different provisions for the 2020 and 2021 tax year. Now we're kind of coming back from those provisions that were set for COVID. So people are probably going to be asking about this credit because last year it was a non-refundable and refundable credit. Typically, it has always been just non-refundable. So our Child Independent Care Credit. The credit may be claimed by taxpayers who, in order to work or look for work, pay someone to take care of their qualifying person. So then this could be a qualifying child, qualifying relative. Who is a qualifying person? A qualifying child who is under the age of 13. So that means they could turn 13 of that year. So expenses prior to them turning 13 will qualify. A person who was incapable of self-care, whom the taxpayer can claim as a dependent or could have been claimed as a dependent except that person had gross income more than the $4,400. A spouse who was physically or mentally incapable of self-care. So these are the only type of 3 individuals qualifications to qualify for the Child Independent Care Credit. When it says incapable of self-care, the person can't dress, clean, or feed themselves. The qualifying person must live with the taxpayer more than half the year. Most of the time we see this credit again for the taxpayer and spouse when they have to put their child in daycare, after school care, or before school care. Qualified work-related expenses. Expenses must be paid for the care of the qualifying person to allow the taxpayer and spouse, if married, to work or look for work. And when it says to look for work, they still have to have had earned income, so they still have to have worked throughout that year. The care includes the cost of services for the qualifying person's well-being and protection, Expenses to attend kindergarten or a higher grade are not an expense for care. That also doesn't include when they're sending their child to private school. This is not, it does not qualify for the child independent care expenses. Expenses for summer day camp are qualifying, but those overnight are not. So they would have to be able to split that out. If it is maybe someone, maybe like 3 or 4, I know they have go off to school or private school, we would have to determine, or the organization would have to give us a form to let us know that it is actually considered kind of like daycare versus, again, not a private school. So there are the 5 tests. We have the qualifying person test, which we talked about again, person under the age of 13, or a person unable to take care of themselves, or it could be a spouse that's unable to take care of themselves. So that means they're physically or mentally unable to take care of themselves. The earned income test. Again, taxpayer and a spouse, if it's a married filing joint return, they have to have earned income in order to qualify. And again, if it's a married filing joint, they both have to have earned income. So it can't be the taxpayer is working, the spouse is at home, and the spouse sends the children to daycare. They both have to have earned income. Now, if the taxpayer, spouse, or one of them are in college, they will treat that college person, that college taxpayer spouse, as having earned income. I think it's up to $250 per month. But they both have to have earned income if it's a joint tax return. Work-related expense test. Again, this is for individuals that you're using this so that you can work or look for work. And then the joint return. Again, they are needing to file, if it is a married filing joint, filing a joint return in order to qualify. Provider identification test. So we need to have a form either from the individual who is providing care. So if someone is using their home, they have to provide their name and social for it to be put on the tax return, or we have to have a statement from the daycare center that provides their EIN number. So we have to have that in order to put this on the tax return. The credit ranges from 35 to 50% of the taxpayer's expenses. The percentage is based on the taxpayer's earned income and adjusted gross income. The amount of the credit cannot be more than the amount of income tax on the tax return. Remember, we talked about the tax liability. It can only reduce it to 0. Some taxpayers receive dependent care benefits from their employers. Employer-provided dependent care benefits appear on the taxpayer's Form W-2 Box 10. If they do have that amount, we need to make sure that it's correct that they did receive employer benefits. If they did, we do have to get a form for daycare benefits. If not, that amount that is in Box 10, it gets treated as income. So all taxpayers who receive employer-provided dependent care benefits are required to complete the Form 2441. That's the child care form that it gets added with their tax return, if they can exclude all or part of these benefits from their taxable income. The credit is limited to $3,000 for one qualifying person or $6,000 for 2 or more. Last year, it increased. It was $8,000 for one qualifying person, $16,000 for 2 or more, because a lot of people were doing a lot of remote. And again, they had provisions where this was actually a refundable credit. So that means it put money in people's pocket. Now it's back to being strictly non-refundable. So the credit, if they paid $3,000 for one qualifying person, and if they're qualified for the maximum credit range, that means they're getting a non-refundable credit up to $1,500 for that one qualifying person. If it's the $6,000, they can get up to $3,000 for that qualifying person. So this is a percentage. This one is not a dollar for dollar credit. And the tax layer, once we input this information in, we have to determine who's the qualifying person. We have to put in the provider, their information into TaxSlayer. So some people may check off that they did have child-dependent care expenses, but if they do not bring that form, they're not eligible for this credit on there because we have to have that EIN number or social. And TaxSlayer is going to populate that form 2441 with the 1040 in all of our schedules. The next credit we have is our child tax credit. This is another credit that has went through some modification changes recently. And so again, it's back to being non-refundable. This last year, it was a non-refundable and a refundable credit. Qualifying child under the age of 17 at the end of the tax year. So that means 16 and younger to qualify for the child tax credit. Some people may say, oh, but this other person qualified. They updated the age last year. Last year it was 17 and younger. It's back to where it was pre-COVID to 16 and younger. So under the age of 17 to qualify for the child tax credit. So 16 and younger. A U.S. citizen or U.S. national resident of the United States. The child must be claimed as your dependent. So children of divorced or separated parents, they are the only ones that are able to split up credits for a child. So they have the custodial parent and the non-custodial. If they decided that they were going to split a child, that means the non-custodial parent claims the child as a dependent. The custodial parent, if they qualified, they could get the head of household. And if they qualified, they could get the earned income credit and the child independent care credit. That is the only situation where a child can be split, but again, they're splitting up the different credits. The non-custodial, again, child tax credit. The custodial, if they qualify for head of household, earned income credit. So the child must be claimed as your dependent. So they have to be listed on the tax return to get the child tax credit. This is your son, daughter, adopted child, stepchild, foster child, or descendant. So it could be a grandchild, a sibling, half-sibling, step-sibling, niece or nephew. They did not provide over half of his or her own support. So these are kind of like that qualifying child rules. Live with the taxpayer for more than half the year and must have a Social Security number that is valid for employment issued before the due date of the return. So this qualifying child must have a Social Security number to qualify. So not an I-10. Any dependent listed that has an I-10, they will not qualify for this child tax credit. And it says issued before the due date of the return, including extensions. So the tax return due date for this year is April the 18th. Someone could, by April the 18th, file an extension. That means giving them to October 15th to still qualify for this. So during the tax season, there are some individuals that go from I-10 to Social Security card. If they let us know when they anticipate on converting over from getting their Social Security card, we could file an extension for them so that they could qualify for this credit. Then we have other dependent credit. So this credit, it's a $500 credit for other dependents who do not qualify for the child tax credit. Remember, the child tax credit is for those under the age of 17. The dependent must be a U.S. citizen, U.S. national, or resident. The dependent must have a valid identification number. Remember, child tax credit, they can only have a social. This one, they can have a social, I-10 number. We don't really do anyone with the A-10 or haven't seen that one. That's for like adopted individuals where they're assigned a number. But this one, you can have an I-10 number or a social. The $500 refundable credit is available for dependents who don't qualify for the child tax credit, such as children who are 17 above. Dependents could be parents, grandparents, are children who do not have, again, a valid social, so those I-10 holders. So any other dependents listed on the return who are not under the age of 17 will qualify for the other dependent credit. And it's $500 for each of those dependents listed on there. And again, these are all non-refundable, so all it's doing is reducing the liability, tax liability, to zero, or getting it close to zero as possible. It says taxpayers cannot claim the credit for themselves, so these are only for dependents. A spouse is never considered a dependent. There's a taxpayer and spouse. So these are only, again, for those other individuals listed on the tax return. A spouse is not a dependent regardless if they work or not. Then we have our educational credits. On here we have the American Opportunity. And so this has always been a split credit. It's always been partial, non-refundable, and then the other part refundable. And then we have our lifetime learning credit. So this is in these education credits. These are on page G. So 4012, page G. So this one has its own section. So taxpayers can take education credits for themselves, their spouse, and or dependents claimed on the tax return who were enrolled at or attended an eligible post-secondary educational institution during the tax year. So this means it has to be recognized by the Department of Education. On there, it could be a trade school, a vocational school, a private college, a non-private university, any type. But it has to, again, be recognized, able to participate in the U.S. Department of Education. So that means these are accredited institutions. So looking at the American Opportunity Credit, and we saw that, going back up here, 40% of it is refundable, which means 60% of the credit is non-refundable. So the American Opportunity Credit, this credit is up to $2,500 per eligible student. So that means more than one individual on a tax return can qualify for this credit. It does have a phase out, but we're not going to worry about the phase out again because of our VITA program. Most individuals will qualify, pretty much all of our individuals, our clients will qualify for the full $2,500 credit. Again, we see 40% of the credit may be refundable, the rest is non-refundable. It is available only if the student has not completed the first 4 years of post-secondary before the 2022 tax year. So that means it's only for undergrad students to qualify for the American Opportunity, not for grad students. And it is for 4 years, so maybe if your program requires you to maybe be in school for 5 years, you only qualify for this for 4 years. You know, if you maybe have to change majors, again, you're getting it for your first, whatever 4 years during your undergrad studies. We have students that come to our site, they go from community college to transfer to a university. Again, it's for the 4 years. And we also try to let them know maybe at a community college, maybe we try to maybe get them to do the lifetime learning credit because it's cheaper at a community college versus a university. But again, you can only get this listed on the tax return for 4 years out of the lifetime for that eligible student. Available only for 4 years per eligible student, including the years the HOPE credit. So before it became the American Opportunity Credit, it was known as the HOPE credit. On there again, it's listed for 4 years in a person's lifetime. The student must be pursuing a program leading to a degree or other recognized educational credential. So that, again, they're pursuing a degree, not just taking classes, maybe taking classes just for their job. Again, that's going to be that other credit we're going to talk about, the lifetime learning credit. So they're pursuing maybe their bachelor's, or they're going to a trade school to get a certificate, will qualify for them for this program. The student must be enrolled at least half-time for at least one academic period beginning during 2022. So that's typically for most of them, I think around about 6, maybe 9 credit hours. And that gets determined. We know if they're enrolled at least half time when we look at the 1098T. So that's not something that we actually have to ask them. We'll find that on the form when we look at that next. At the end of the year, the student had not been convicted of a felony for possessing or distributing a controlled substance. So that disqualifies them for the American Opportunity Credit. I'm assuming maybe because, it disallows individuals to qualify for FAFSA on there. So that is a question that we do actually have to ask on the taxes, in TaxSlayer, if a person is going to get the American Opportunity Credit, making sure that they have not been convicted. Tuition, required enrollment fees, and course materials that the student needs for a course of study, whether or not the materials are brought at the educational institution as a conditional of enrollment or attendance, qualify. So room and board does not qualify, that's not listed. So they cannot get a credit for room and board, they cannot get a credit for medical, you cannot get a credit for transportation. It is just the tuition, required enrollment fees, course materials, as well as they allow with your books and supplies, if your laptop, like maybe if a person is in the medical field, like they have to buy the skeleton. Maybe the nursing field, if you have to go to one of the hospitals and you have to wear the uniform, that would be included in here, that you're gonna add to all of those fees to help you get to your credit up to the 2,500. Payments made in the 2022 for academic periods beginning in 22 are beginning in the first 3 months. So we're looking at those amounts that a person paid to the university, to that institution for the 2022 tax year, as well as payments made in January, February, and March of this year can qualify for next year. And a lot of times that depends on the institution if they're going to use those first 3 years and put it on the form. And then there's a box on the 1098T to let us know if they've already put in the first 3 months on the 2022 tax form. Filers and students must have a TIN, so that can be a social or ITIN, by the due date of their return, including extensions. So if they don't have a social or ITIN, maybe and they think they will qualify for this, we can file an extension, giving them to October 15th to file a return to qualify for this credit. You must provide the educational institution's employer identification number. So we have to have that institution, their EIN number, and it's going to produce the 8863 form that populates with the form 1040. Also with the American Opportunity Credit, so we do have some individuals that in most situations they will be considered a dependent just based on their age, but filing as an independent to get this American Opportunity Credit. TaxSlayer is going to ask these questions. So none of the credit, the American Opportunity Credit, that 40% is refundable if 1, 2, and 3 apply. The taxpayer claiming the credit is under the age of 18 or 18 at the end of the year, and their earned income credit was less than half of their own support, or a full-time student over 18 and under 24, and their earned income was less than 1/2 of their own support. So the way we can ask this question is, we ask them, did they provide more than half of their support? That means, are they paying their rent, their utilities, their food? Did the student provide that themselves? And also, if they're saying they got assistance, but was that assistance from their parents, was it considered a gift, or was that actually considered support? So there's a couple of ways that we can kind of look at that, on there. Also, the taxpayer has at least 1 living parent, and 3, the taxpayer doesn't file a joint return. So this is to determine if 1, 2, and 3 apply, then they will not qualify for the refundable portion. That is $1,000 on their tax return. So we do have to address this. And again, the way we address it is definitely seeing if that student, did they provide more than half of their own support. Now getting to the lifetime learning credit. And so seeing some of the differences, the lifetime learning credit is up to $2,000 a credit per return. So we saw the American Opportunity is up to $2,500, and that could be per eligible student. So the American Opportunity, the taxpayer, the spouse, if it's a joint return, all dependents listed could qualify for the American Opportunity credit. That means everyone on the tax return could get up to the $2,500 each for the American Opportunity. For the lifetime learning credit, it's only up to $2,000 per return. So the taxpayer, spouse, and any dependents, if they're all in school, regardless if they all qualify, and regardless if they all technically would have qualified for the $2,000 each, it would only give them just the $2,000 per tax return. Again, we're not going to look at the phase-out income. This is a non-refundable, just strictly non-refundable. It's not split like the American Opportunity. This non-refundable credit is limited to the amount of tax you must pay on your taxable income. So this credit, it is 20% of those qualified expenses on there. It is available for all years of post-secondary education and for courses to acquire or improve job skills. So if a person is just taking a class just for their leisure, again, improving their job skills, or they're in grad school, this will be the credit that they will qualify for. If they're taking one class, two classes, they're not considered a half-time student. If there's an undergrad and not considered part-time, this will be the credit that they will qualify for. It's available for an unlimited number of tax years. So as long as they allow this lifetime learning credit on a tax return, as long as it's available to claim, an individual can take it. So they could be taking classes, one or two classes, and they've been doing this for 10 years. As long as it's on the tax return, they meet the qualifications, they can get this lifetime learning credit. The student does not need to be pursuing a program leading to a degree or recognized education credential. So that doesn't mean they're trying to obtain a degree or certificate. They could just be, again, taking classes at their leisure. Available for one or more courses. The felony drug conviction does not make the student ineligible. Tuition and enrollment fees, including amounts required to be paid to the institution for course-related books and supplies. So that means it has everything, tuition, books and supplies have to come directly from the institution. American Opportunity, you could go to Chegg, you could go to Amazon to get your books or supplies. You could go anywhere to get your material. The lifetime learning, it has to come directly from the institution. And then payments made in 2022 for the academic periods beginning in 2022 are the first 3 months of 2023. So you can use January, February, March of this month and add it on your 2022 tax return. But remember, you cannot then duplicate it when you go to your 2022 tax return because you've already included those first 3 months on the prior year. So on this 1098-T that we're going to look at, Box 1 may include non-taxable scholarship and grant income. Some students may choose to pay non-qualifying expenses with scholarship Pell Grant funds, making the scholarship Pell Grant taxable. This is true even if the scholarship or grant was paid directly to the school. This may increase the amount of qualifying expenses that can be used in calculating the education credit. So there is a way, when I went back to the education pub, that if a person does have more scholarship and grants, and maybe they're a dependent, we can possibly put some of that scholarship and grant income for the student to qualify as compensation. Remember, in the income topic, we talked about with the W-2, other forms of compensation. We talked about excess scholarship and grants, and it gets treated as W-2 income for the student. if we reduce or put some of that on the student's tax return, the parent may be able to get this education credit for the student on their return. But that kind of requires both the student and the parents, the taxpayer and the dependents, to come and get their tax return prepared at the same time. So people are always asking, how do people, maneuver or how are some people able to get, refunds or something? So there are certain techniques, again, qualifying, where it does allow someone to get a refund. And this is one of those. The student will be reporting some of this scholarship and grant as income, meaning that they would then have more expenses still left on the 1098-T, giving the taxpayer's spouse hopefully a larger credit or a credit for the education credit. So here is the 1098-T. So it's going to have the institution, that university, trade school information listed. It's going to have the student's name, the student's social or ITIN. And we're looking at the amounts in box 1. These are the payments received for qualified tuition and the related expenses. Box 1 does not include books. It could be maybe for those institutions, like those online schools like University of Phoenix. Those type of colleges, typically they will include the course material. But for here, UTD and Richardson, if you have to go and get your own books and supplies, that's not included in box 1, because you have an option where you can go and get those. Again, Amazon or Chegg. So we would have to add books and supplies to here. Any other things that are required for your degree or major, like if you have to have maybe a specialized calculator or something. Then we look at box 5, scholarship and grants. So your credit is based upon box 1 minus box 5, and what's that net amount? Or we can say box 1 plus those books and supplies minus box 5. So your credit, again, based on that net amount. To determine if it's going to be the American Opportunity or the Lifetime, again, we're going to be looking at box 8 and box 9. If we see that box 9 is checked, we know the only option is the lifetime learning credit. If we see that box 8 is checked, that means that's letting us know they're at least a half-time student. Box 9 is not checked. So then we get to determine, based upon what that net amount is, do we want to use the American Opportunity or Lifetime? So that's where it comes in when I'm talking about those community college students. Maybe they only have a net amount of $500. Do we want to use the $500 to get their American Opportunity, or just use the lifetime learning when they're going to transfer, and the cost of attending school, the tuition is going to go up? Also, if we see that this is not checked on here, even though box 9 is not checked, we also know that it's going to be a lifetime learning, because American Opportunity, they have to be at least half-time. So this helps us determine what type of credit they could be qualifying for as well. And like I told you, there are some colleges that opt to use the first 3 months in the following tax year. We would know if we would know if they did that when this box is checked on the 1098-T. So the box in box 7. Okay, we're getting to a poll question. So all of these taxpayers contributed to their employer's 401k plan. Who qualifies for the retirement savings credit based on adjusted gross income? So you see we have our options. You're going to go back and look at that retirement contribution credit worksheet on there and let us know that is Ed, Sybil, Megan, or Carl, which one of them qualify for the retirement savings credit? Who do y'all think? Okay. Okay. It is Sybil. Her adjusted income is under the threshold limit for the married filing jointly. Jose and Yolanda are married filing jointly and have 5 dependent children under the age of 17. Now, Jose and Yolanda, they both have valid socials. Their children have ITINs, the individual taxpayer identification number. Are their children qualifying children for the purpose of the child tax credit? No. Correct. They do not qualify. Now, will qualify them for the credit for other dependents. So they will get the 500 credit for that, the other dependent credit, up to their tax liability. Bob was a full-time student and a 5th-year senior. He has only claimed the American Opportunity for the 3 earlier years. Does he qualify for the American Opportunity credit? Correct. Yes, he does. Because he's only claimed the credit for 3 years. Janice works full-time and takes 1 course a month at night school. Some of the courses are not for credit, but they are meant to advance her career. Which credit is appropriate for her? Yes, she's going to get the lifetime learning.